Congratulations.
We are
Good start
rolling.
to the month.
Good start. And you're funded today.
Good start. What?
Half hour ago.
Right.
Yeah.
That is
It's wonderful.
all right.
Episode 6.
Episode 6. All right, here we go. Hello and welcome to another episode of the Lending Podcast. We are your hosts. I'm John Burnham. This is Jeff Jones.
Logan.
We are excited to be back with you today. We're going to talk about jumbo loans. We get so many questions about conventional loans, conforming loans versus jumbo loans. We're going to dive into that today.
We're going big today.
We're going big.
We're going big.
Well, we do it big in Texas.
So in our industry, a jumbo means anything over the conforming loan limits that are required by the federal government to keep them into what we call a qualified mortgage standard conforming. Anything above that number, which changes basically every year, gets reevaluated. And anything that goes above that in loan size has a completely different category that we call jumbo residential.
That's right. And right now, the conforming loan limit in Texas is $766,550. That is pretty common throughout the United States. There's some high balance areas. California comes to mind. It's a little over 1.1 million for a conventional conforming high balance loan in California. So the jumbo versus the conventional conforming loan limits are going to be different in various states. However, in Texas, throughout all counties, we're $766,550.
And that's for a single family home. If you go to a 2-family, it's a higher limit. 3, 4, those increase as the size of the property increases for family size.
That's right. And for a duplex, let's just say owner-occupied duplex purchase, the conforming loan limit is pushing $900,000.
Right.
So it's not even a jumbo. So we're talking about single families, anything over 700. Let's just say 767,000 and up is our jumbo market. So let's dive in, kind of talk about what is a jumbo, why is it different, why does it matter, and some of the qualifications that we see where we as loan strategists are shifting our clients sometimes into a jumbo or away from a jumbo based on their specific situation. So the biggest thing that comes to mind is jumbo investors are individual investors. These are banks that you might drive by one of these banks and see the sign on your way to work. It's those kinds of banks. And it's also names of banks that you've probably never heard of, right? We work on behalf of all of these different lenders. I think we have probably a dozen different jumbo investors that we underwrite on behalf of. And that's called delegated underwriting, where we are underwriting on behalf of the guidelines of the investor. And we are closing and funding those loans as benchmark mortgage and then transferring the servicing to the respective bank. Now, here's the interesting thing. When we look at the jumbo matrix, we call it a matrix. We have, let's say, these dozen lenders that we're looking at. They have different debt to income ratio limits. They have different loan to value limits. They have different requirements on cash reserves. Some of them want to have 6 months of cash reserves in the bank. Some of them want to have 12 months cash reserves. So the takeaway really when you're going over 767,000, what you need to know is the qualifications for obtaining a loan that size are different than every other loan at 766 essentially and under, because those are all pooled. All those conforming conventional loans are pooled together, sold to Fannie Mae or sold to Freddie Mac, and they're very standardized versus these investors have individual guidelines.
That's good. So the majority of time when you hear lending professionals talk, they're talking about a Fannie Mae or a Freddie Mac underwriting guideline requirements. And so when they're talking about like, these are the ratios, you got to be like at this debt to income, you got to have this much asset reserve. They're talking about Fannie and Freddie guidelines. I love how you said it, like each jumbo loan, when you get above that 767 loan limit, you're getting into a whole different playground of different people that have guidelines. And each one can have their own set that is vastly different. So if you get a $800,000 loan and we're looking between these, a dozen different jumbo investors, they drastically different. So it's not the same kind of guidelines. We can't run it through this automated underwriting system and get like a yay or nay. What we have to do is put it into that paradigm of those guidelines, throw it into what we call like the matrix, I just rewatched that, by the way. It was
That's
awesome.
a
It still
good
holds
movie.
up today.
Yes.
Um, and see if it's going to fit, right? And so it's a different kind of world.
It really is. And I think let's just take as an example, we have a lot of clients that work at Apple. Okay. And Apple will provide their clients sometime or their employees with salary and something called RSU income, which was
Residual.
restricted stock units.
Yeah.
Well, RSU income shows up on your W 2. So you see, we look at the W 2, W 2's really good looking W 2.
Right.
Half of that income might be RSU income, and multiple investors, including Fannie Mae, do not allow RSU income to qualify.
At all.
You've got
Like
executives
0%
at,
of it.
say, Amazon or Apple
Right.
who, on paper, make enough to stroke a check for this house and cannot qualify for a mortgage on certain programs
Right.
because RSU income is not always allowed.
But here comes Jumbo.
That's right. And so Jumbo will allow, there's several investors that do. Also, Freddie Mac on the conventional side will allow RSU income. So there's ways to navigate through, but no two loans are alike when we really dive into it. So also something interesting to note is we can go up to, in many cases, $3 million on a jumbo mortgage.
Right.
There are some investors that may go to 4 and 5. It depends. There's some exceptions that can be made. That's one thing about jumbo investors also is they will make exceptions. Certain investors will make exceptions if it makes sense because, again, it's their money.
Yeah.
They're not packaging that loan up and selling it most likely. They're actually going to service it and hold it and take payments in many cases. And so the loan amounts, and this was interesting too, because we were talking off camera about a lot of our clients that will come in, we'll talk to a client, and let's say they're paying $5 million, they're paying cash, and they decide, or $7 million, they're paying cash. And we have one right now that chose to pay cash for $7 million. And listen, if you're in a position to do that, that's amazing.
But
More power to it. But talk to your financial advisor.
100%.
Is it better to finance $1 million or finance $1.5 million and let that money work for you? Keep that in your brokerage account.
Right.
I mean, I looked the other day. I think I have a couple different brokerage accounts. One of them was up 20% year to date. So if you're borrowing money at 7 or 8% and you can go make more than that in the market, that's something to talk about with your financial advisor. And no, it's not going to put you through the ringer. It's not going to be too difficult. It's not going to stress you out. It's not going to be a second job. If you're borrowing $1 million on a $5 million house, that type of loan will move through the system. Even if your income is unique, even if you're self-employed and maybe write off a lot of expenses on your taxes, whatever the situation is, there's a jumbo investor that's going to be able to navigate through that, especially at that kind of equity position.
I think that's a huge point is we love our financial advisors.
We do.
They are a great team to have talk directly to your lender for you as well. And what we like to do is just get on the same page of like, what is your long-term goals? What are your short-term goals? Because those are very different strategies, right? And your financial investor needs to know what both of those are too, so that we can pal around each other and go, yes, let's leverage a loan so that money can work for you in the market, not just in the housing market, but it can earn more possibly in your brokerage account. So we need to know that so we can have the right structure.
Right.
So it is wonderful when borrowers set us up with a direct line to their financial advisor and we have those wonderful conversations about your future for you, with you, and go, hey, JB says he wants to make sure he's got, in retirement there in 10 years that's at this amount. Do you need to get a loan out on this property so you can get that into the brokerage account, get that 12 to 20% growth year over year? Or is he good at having that in the property, 7% interest?
That's right.
Whatever it might be. So we want to make sure we have a direct line of access to financial advisors for you if you have them. That's a big deal.
And that's a good segue into interest rates because that is typically one of the biggest maybe misconceptions is that jumbo loan rates are significantly higher than conventional loans. Now, there was a time, this is interesting because the way that conventional rates move, they kind of move by the hour sometimes. Like they can move on a daily basis, they can move multiple times up or down. Jumbo loans are kind of like the tortoise, and conventional loans are more like the hare. You've got conventional loans that move frequently, and these jumbo loan rates don't necessarily move like the Fannie Mae rates do, because again, these are private investors a lot of times whose money is set. The cost of funds for that money is more set, and it moves slowly. So what does that mean? In a higher, rising interest rate environment for conventional loans, your jumbos could actually be priced better. It could be lower interest rate in some cases than a conventional mortgage. When mortgage rates for conventional loans, which is kind of what you see if you Google what's a 30-year fixed mortgage today, it's usually a conventional loan. When those are rapidly declining, your jumbo rates could be lagging. They could be higher still than your conventional. So one of the things we wanted to touch on too is sometimes it makes more sense to split up a jumbo into two mortgages. So right now, before I go there, I will tell you that as of this is spring 2024, right, March 1st, our jumbo rates and our conventional rates are pretty close. They're within a quarter of a point. So let's just say the average 30-year fixed is between 7.25. Your jumbos may be 7 to 7.5, somewhere in there. And that's kind of where we are right now. But the nice thing about looking at both strategies is sometimes breaking up that jumbo. You could have $1 million loan as a jumbo, or you could do a $750K first mortgage with a $250,000 second mortgage, split it up, and with that blended rate, kind of touched on in the last episode, but that weighted average blended rate might be better in some cases than doing $1 million loan. You do a 750 and a 250, and then we call that second loan a piggyback.
Right.
So it's a second mortgage. It's a second separate bank. It is underwritten separately. There are pros and cons to all those things. We'll evaluate those with you. But the main thing is, the one loan, the jumbo guidelines may be for your particular situation might not be the best fit, and you might fit into the matrix better of a conventional conforming loan because of your income type, because of your credit score, because of your asset base, whatever those characteristics are, might work better to do a first and a second versus a jumbo. So it's just nice to have the alternative, have options out there.
That's key. I think that, when we enter into this kind of scenarios of, I'm getting into the $1 million range of a property and I don't know, what this monthly payment will look like. So when you're talking about having a first mortgage and a second mortgage and then that can also change your down payment amount quite a bit.
Yes.
And so you have a lot more flexibility of down payment options.
That's right. Let's touch on that for a second.
Yeah.
So let's say we have $1 million buyer and they have 10% to put down, $100,000. Pretty good down payment, right? $100,000 is a good chunk. However, most jumbo investors want to see 20% down. There are some exceptions. Again, all these things are discussed. They're all unique to our client specific situation. But most of the time, your vanilla jumbo mortgage is 20% down, right? To get a better interest rate. You can do 10% down. It's maybe not as good a terms. So when we touched on the piggyback loan, the first and the second, in that scenario, you could do a $750,000 first, a $150K second. That's a $900,000 loan, the same as a $900,000 jumbo loan amount wise, total loan amount. But if you have to put 20% down on the jumbo side and you only have 10%, splitting it up into two mortgages would be a way you could still buy a $1 million house and put 10% down.
And not have mortgage insurance?
Imagine
PMI. That. Because both loans are under 80% loan to value.
Well, the first mortgage.
No, but the first one's 80.
Is under 80,
but it's not over 80.
Exactly.
So that's what keeps the mortgage insurance away.
That's right.
Good.
Yeah, and that blended payment comparison is something we would crunch the numbers on. Again, your interest rate's going to be comparable. The second lien rates right now are actually pretty in line with the first lien. They're maybe just a little higher than the first lien. Obviously, the second lien position has a little higher risk, right? Because they're in second position. And this is also a good strategy for if you have some chunks of cash coming. Maybe you are in a commission-based situation. Maybe you have your income fluctuates as a self-employed business owner and you have kind of chunks of cash that come in. You could take a big chunk of money and start paying down on that second mortgage, it's almost like car payment, get it paid. Right. And then as soon as that second lien's gone, you're sitting on that first mortgage and that's your only mortgage because they are two different banks.
Right.
And they're two different payments.
And so, that's that timeless advice of pay off your highest interest first.
That's right. Right. That's true. Exactly.
That's good.
So yeah, again, the jumbo and jumbos. This works for refinances too, for cash outs,
Yeah.
and so we see these cash buyers that want to use that leverage in our marketplace to make a cash offer. Do that if you have the ability and you can pay cash for a property. We're not saying don't pay cash, but look at the alternative, possibly of financing some on the front end, but also paying cash, coming back and taking out a cash out mortgage. Pay cash, use that leverage, come back, put a loan on the property, take that cash, give it back to your financial advisor, and say, hey, go make me more than 7%. And then you've just leveraged that $1,000,000. You still have the $1,000,000 in the bank. And of course, you can pay the loan off at any time. There's never prepayment penalties. None of the loans we do have prepayment penalties if it's owner occupied. Occasionally, you'll see a prepayment penalty if it's an investment property, but it's very rare right now. So if you're buying owner occupied, you're buying a second home, you're not going to have a prepayment penalty. So you can pay it off at any time.
Yeah, and just to kind of highlight that scenario, people want to pay cash, but then after they own the property, then they can pull equity out of it, right? And I think that could be very good scenarios for a lot of people as well. Like a lot of people don't realize what that does for them, especially with their financial advisor involved, and go, hey, now that you own this property, what does a mortgage look like on it too?
That's
So
right.
even if you've done cash buying and you're still curious about that, we'd be happy to run scenarios for you and look at what that looks like.
For sure. And that's also probably pulling your CPA in on that as well. So
Yes,
you've got CPA, financial advisor, because let's be honest,
taxes are involved.
if you yeah, well, I mean, what is the so let's just say $1,000,000 mortgage at 7% interest rate, right? So that's 70 grand a year in interest. What does that interest deduction look like? So 6,000 a month roughly. What does that interest deduction do for your tax advantages
Right.
on your income taxes? Because you're definitely going to be over that standard deduction that the IRS gives you. And so if it reduces your taxable income, changes your tax bracket, reduces the amount that you pay the IRS, and you've got your financial advisor making money on your money, that's the equation that it's not really, it's outside of the mortgage really.
Yeah.
It's helping you with your personal finances. And that's really looking at the picture holistically. And there's a lot of advantages to doing that. So we'd love to see those CPA, financial advisor, borrower, loan officer conversations where we can put a better picture together for you and make sure that you're taking advantage of all those benefits that are out there for you.
Yeah. And in our day and age, a lot of industries are what I call siloed. Like we're independent. We don't talk to each other. As you can tell from how you talk and I talk, we want the collaboration
Absolutely.
because a team around you that is strong and communicating well around your best interest together gets you to the place that you want to get to faster and basically much more in unison and simplified for you, but if your lender is not talking to your financial advisor, if your lender doesn't know what's going on with your CPA, they might even get frustrated with each other, and the opposite can be true where we're actually working against your goals and we don't know it. So
Right.
that's a big deal to get that, basically that the trifecta of people in your finances together to talk.
Have your trusted advisors.
Yeah,
Exactly. Your
good.
trusted advisors. And Jeff and I are as advisors to you more than loan officers, looking at that whole picture and collectively owning investment real estate, owning commercial property, owning primary homes. Like there's a lot there that of experience there we can
Yeah.
share working with investors and so many different multi-million-dollar property buyers and your first-time buyers and your investors, second homes, all those different strategies, all those different scenarios and putting strategies together. That's what we love to do. So looking forward to helping you on the next one as well.
Yeah. So again, thank you for tuning in to the Lending Podcast with JB and JJ. We appreciate you watching. If you can like, share, subscribe, that would be huge for us because we love bringing good information out there to the public. Thank you all.
Take care. We'll
Bye.
see you soon.